Hi guys, welcome to chapter 12. We're doing special property transactions, and this really follows up from chapter 7. So first thing I want to do is give a little review, everything about assets. I know that there's a lot going on with assets. It's a really big area of business taxes and business investment in general. So in chapter 6, we covered when you purchase an asset that you don't get to write it off as an expense. Instead, you have to capitalize the asset. Now, you may recall this if you've taken accounting classes, that this means we're recording it as an asset on our books instead of as an expense. And we do that because it's something that's used in a business to earn money over time. And we want to match the expense of getting that asset and the value, the income that it helps us create each year. So there are accounting depreciation rules and tax depreciation rules. Tax depreciation rules are certainly stricter for most businesses. And so we covered this stuff in chapter 6 under self-employed taxes. Form 4562 is a form that calculates depreciation, and the depreciation amount flows to Schedule C, that self-employed business form. But you only have this form in the first year of purchase. So it's something to be aware of so that you keep copies so that you can tell what depreciations you've taken, what type of depreciation expense on each year. So then we just did chapter 7, which was gains and losses, and that was from selling these assets. So when we purchase, that was chapter 6, selling, we have to calculate if there's a gain or a loss. Even if people think there's a loss, we've got to check especially because of depreciation recapture. A lot of times people don't realize they've been taking deductions on their tax return. Okay, and so the way we calculate that gain or loss and how it's taxed is based on holding period and use, right? Business or investment, and of course, personal as well. Form 4797 is sale of business property, and then certain amounts flow to Schedule D or directly to be taxed. Now, in this chapter, it made sense to do this chapter next because it's also about assets in its special situations. So like-kind exchanges is a common special transaction for taxes that's used for businesses and especially real estate investment. Especially now with some changes, it will be primarily real estate investment. But what it allows you to do is defer that gain that may have resulted up here. It allows us to defer it by getting another similar property. And that's reported on Form 8825. And then we have installment sale income. So often if someone sells an asset, then they'll be paid for it maybe more in more than a year. So they may get multiple payments over more than a year, and that becomes an installment sale method can be used, which is reported on Form 6252. And so some other things to consider with special property transactions, people often try to, finagle deducting losses. And so we disallow the benefits of these special transactions for related parties and wash sales, which are in regards to stocks. And we'll be talking about those things in this video. So the general rule is that, when you sell property, an asset, gain or loss must be calculated, realized, and then a portion recognized. Remember, realized is the amount that's calculated. recognized is the amount that's actually taxed. So certain situations allow for us to defer gain to a future year, and we'll be using that term more in this chapter. And so that means when you defer a gain, you are excluding it from taxable income, but we don't refer to it as excluded because it will be taxed in the future. And that's why we use the term deferred. Losses can be disallowed for certain situations, like-kind exchanges. So all business property, business includes rental. The Tax Cuts and Jobs Act of 2017 in December really changed like-kind exchanges. Now, previously, they applied to all business and rental activity. So equipment and real estate, land, and rental properties. So any commercial or residential properties, rental or business, and equipment was a big part of like-kind exchanges. However, so in the problems that you're going to do in the chapter, you are using the older rules for 2017 right before this act took place. So equipment qualifies and was a big part of it. However, the Tax Cuts and Jobs Act made it so that it no longer applies to business equipment. It only applies to real estate. So real estate includes land, residential or commercial, as long as it's being used for a business or rental purpose. The other thing to keep in mind is that it only applies to these types of assets. It doesn't apply to any other types of assets, and it doesn't apply to other assets, real estate, land that's outside of the U.S. It has to be inside of the U.S. So 3 things that must happen for like-kind exchange to exist per the book. An exchange must occur, property transferred and received, and must be held for productive use in a trade or business or for investment, which means it must be for the purpose of earning money. And that's the very technical tax definition, or how it's worded for tax. So property exchange must be like kind. Now, when it comes to real estate, this is actually a pretty broad category, anything in the real estate category. This is a fairly loose definition for the IRS, same in nature and character. And so for that, the general depreciation class applies. So if something was 7-year property for depreciation, remember, which applies when we purchase the asset, then you could exchange a property for 7-year depreciation, as long as it was in the same class. And then we know more detail. I don't want to imply that they're not picky. They are very picky according to, their rules, which there's all sorts of case studies and legal challenges. So it's very clear what qualifies. I don't want to make it sound like people can slide anything in there. It's very clear, but it is a fairly lenient definition, allowing for a lot. So the benefit of qualifying as a like-kind exchange is that you get to defer gain, excluding it from income in the current year. When you sell the property later on, you will then be taxed on that amount. So gain is deferred by decreasing basis. When gain decreases our basis in a property, when we sell it, remember, income minus basis equals gain or loss. So if our basis gets smaller by the amount of the gain, then when we sell it, we're going to have bigger gain then. And it's deferred because it's not realized, it's not recognized, and so the amounts will affect the basis in the new property. When you sell or exchange the property later on, deferred gain impacts calculation. All right, boot, an interesting word. So we have a like-kind exchange. Two people are exchanging a property. Boot is consideration, which is value. Because when you exchange two properties, right, they're going to be worth the same, but it's very unlikely that you actually find two properties worth the same. And with real estate, and even within equipment, they only have to be in the same depreciation class, which includes all types of assets and many, things of different value. So boot is additional value, often cash, that's thrown in so that the exchange is fair. Now, boot triggers taxation, recognition of any gain on the sale or exchange. And other things can be considered boot as well. Anything that is not the like-kind exchange property is boot. So even if someone, assumes a liability or gives another piece of property or cash, it's all the same. It's all boot. So steps in looking at these like-kind exchanges. First, you have to calculate the gain or loss. So our sale price, fair market value of what we receive, plus any boot that we receive. And then we subtract out our basis in the old property. And that equals a gain or a loss. So it's a little bit different, but exactly what we were doing in Chapter 7. It's just that now we include the fair market value of the property we received and any boot we received. So the total value of everything we receive, just like before, the sale price, minus our basis equals gain or loss. Second step, we have to determine if we have to recognize any of our realized gain because we have boot. So as long as we qualify as a like-kind exchange, and there's a lot of qualifications, we'll talk more about those, but you're not covering that much in the questions, so you don't need to worry about it too much. But just realize, as long as it actually qualifies for a like-kind exchange, if boot is involved in the exchange, then we have to look at recognizing a portion of this gain based on the lesser of the fair market value of the boot received. So if you got $10,000 cash, that's $10,000 cash. If a $10,000 loan was assumed, that's $10,000. Or the realized gain on the exchange, whichever is less. So you're recognizing the gain here to the extent of the boot that was received. Just like when we went over depreciation recapture for Section 1231 property in Chapter 7, where we recapture to the extent of gain. Same thing here. So that becomes, if we have had gain, a boot involved and a gain, then we'll need to determine what amount of gain is going to be recognized, which means taxed on the return. And then from there, we can calculate our basis in the new property. So we start with the fair market value of the property received. We subtract any deferred gain, and we add any deferred loss. Remember, that's what I was saying before. When you decrease your basis, then later on, when you sell for the same price, you're going to pay tax on more, and the loss has the opposite effect. And so that equals basis in the property received in a like-kind exchange. So now we're going to calculate gain or loss here. If I can get my face out of the way. No. So this is a little more detail than that step 1 on the last slide. So when we're calculating the sale price, we start with the fair market value of the property we received. We add any boot received. And then when we subtract out our adjusted basis, we start with the basis of our property that we gave up in the exchange, minus any boot we gave. So if we paid cash or any other way, contributed other assets, assumed any liabilities, we subtract the boot given, and that equals gain or loss. So it's kind of intuitive for calculating a gain or loss, and that, remember, is the amount realized. From there, we determined, was boot involved? How much of that gain do we need to recognize, meaning be taxed with it? So now we're on to that basis calculation. So we start with the new property received. To get the basis of the new property that we received, we start with adjusted basis in the property that we gave in the exchange. We add the basis of boot that we gave. We add gain recognized from the very last step. If we receive boot, then we had to recognize gain. If not, it's 0. Then we subtract the fair market value of boot that we received. So you got to keep track of the differences. Boot that was given versus received. Subtract any loss recognized, and that equals the adjusted basis of the new asset. So one thing to keep in mind when you do these problems, write this out right next to it. Why it's so hard to move that. Okay. So transferred property with an adjusted basis of $10,000 for property with a fair market value of $11,000. This is a basic example. So we'll just say it qualifies as a like-kind exchange. I gave up a property that I had a basis in of $10,000, and I got a property with a fair market value of $11,000. Do we have a realized gain? What is the realized gain? Sale price is what we got, $11,000, minus our basis, 10. We have a realized gain of $1,000. But is there a recognized gain? Did I get boot? No, 0. Basis in the new property. Basis in the old property. And if you look at that list that I just went through, nothing else applies. Let's do another example. Sonja exchanges a machine used in a business with Kelly for another machine. This would not be applicable anymore because there's only land allowed in 2018, land and real estate, of course. Sonja exchanges a machine used in a business with Kelly for another machine. The basis of Sonja's old machine was $25,000. Its fair market value $33,000, and she gives cash of $7,000. Kelly's basis in her machine is $35,000 and fair market value is $40,000. So we're calculating Sonja's gain or loss. So gain or loss, we've got to start with what was the fair market value, the sale price of what Sonja received. $40,000. She's going to receive Kelly's machine. So fair market value of Kelly's machine was $40,000 minus the basis of her machine, $25,000, and minus the cash she gave up of $7,000. And you've got to look at that calculation. But that kind of makes sense, right? Because she put that money in And so that brings her down to an $8,000 realized gain. Now, do we have to recognize any of it? We subtracted 7,000, but she didn't get any boot. She gave boot, she didn't get boot. So no recognized gain. Basis in the new property. I copied this over to follow it, but you should follow it even for gain or loss. Okay. Basis in the new property. Adjusted basis of boot given up. Adjusted basis of boot given up. That's supposed to say adjusted basis of property given up, which is Sonja's machine right here, 25,000. Then that's this first one, basis of property given, 25,000. I just didn't line it up exactly. Adjusted basis of boot given up. That is this 7,000. See what's happening here? Gain recognized. We didn't have any gain recognized. Fair market value of boot received. There was no boot received, only boot she gave. Loss recognized, there was no loss. That equals our adjusted basis of 32,000. So that's for Sonja. For the next one, we'll do Kelly's side. So Kelly's gain or loss, what did she get? She got the fair market value of Sonja's asset. She also got $7,000 cash. We subtracted this on the giver's side. We add it on the receiver's side, and then she subtracts her basis. And that's going to equal a $5,000 realized gain. Now, do we have to recognize this gain? Did she get boot? Boot? Yes, she got 7,000, right? So does she need to recognize 7,000 or 5,000? Whichever is less, right? So 5,000. Now the basis in the new property. We start with the basis of property given up. So Kelly gave up $35,000 basis. And then we need to add basis of boot given up. She didn't give up any boot, right? This is all of her information. So 0. Gain recognized, add gain recognized. Well, we do have a $5,000 gain recognized, so we need to add that. Minus fair market value of boot received. She got boot received, 7,000, so we need to subtract that. No loss, and so her adjusted basis of the new asset that she got after the exchange is 33,000. Okay, another one. Julie transferred a building with an adjusted basis of $240,000 for another building with a fair market value of $350,000 and $25,000 in cash. It is a qualified like-kind exchange. What is the realized gain? How do we calculate the realized gain? Gain or loss, sale price minus basis. And in this case, we start with the fair market value of the other asset. So Julie transferred a building with an adjusted basis of $240,000 for another building with $350,000. We only have one side in this equation, which actually makes things easier. What did Julie get? $350,000. What else did she get? Boot, $25,000. Then we subtract out her old basis. We have no idea what the fair market value was on this, but presumably it's $375,000, right? And that's why this person put in another $25,000 with $350,000, regardless of the fact that her basis is lower. So that equals a realized gain of $135,000. Now, do we have a recognized gain? We have $25,000 cash and $135,000 realized gain. Which is less? $25,000, I don't think I put it in here. The last one, new adjusted basis in the new property. It's just her old basis plus adjusted basis of boot given, 0. She only received boot. Gain recognized. Gain recognized should be $25,000 minus the fair market value of boot received, $25,000, and so this should be $240,000. So that's a mistake I made here. This should be gain recognized. Remember, I just said this is $25,000. Interesting, I didn't write it out there, and that's how I missed it. So it should be 240 plus 25 gain recognized minus 25 fair market value of boot received equals 215,000. Like-kind exchanges. So these are a few other concepts to be aware of. Holding period carries over from the previous owner. You must identify a property within 45 days. And you must receive the property within the earlier of 180 days of having given the property up that you're exchanging, or the due date for filing a return for the year of the transfer, including extensions, whichever of those is earlier. Now, you may be like, wait a second, this is an exchange. Well, deferred exchanges are not even necessarily an exchange, and that's why they added this. As long as the person who sells an asset doesn't get the cash and they have a broker manage the money for them, then they can qualify things as an exchange, which are essentially a sale and purchase, which is what a deferred exchange is. And there's just more rules around it, but essentially the owner cannot have constructive receipt of the sale price. Now, related parties essentially remove recognition of gain or loss. So if a related party like parents, family sell something to each other, then that person can't take a loss. And let's say a family member sells something to a family member, and then a year later they sell it to someone else. Because it wasn't 2 years after that, then the middle sale between family members just doesn't count. So the adjusted basis of the original family member is what you use to calculate a gain or loss, and you just skip the family sale in between. Involuntary conversions. So this is the technical definition here. Property is destroyed, stolen, condemned, or disposed of under threat of condemnation. The most common thing that happens is that like state governments or various governments will take land in order to build some sort of public works. Of course, this is a huge issue with Trump's wall, is that they have to take so much property from owners of the property without necessarily having their consent. Now, if it's a qualified involuntary conversion, there's no gain or loss recognized, and basically it's very much treated like a like-kind exchange, only with some more beneficial aspects. They must replace the property within 2 or 3 years, so they have a longer time period. If they receive insurance proceeds, it's basically treated like boot, and they just need to reinvest that into another property to avoid having to recognize gain. Losses in many of these situations, stolen, destroyed, can be treated as a casualty loss, which is a tax deduction. However, it's very limited. It's only an itemized deduction. It's limited by $100, and then 10% of the adjusted gross income, AGI, on the tax return. So it's a circular calculation, and it can be heavily limited. And of course, that amount is reduced by any insurance proceeds or compensation that is received, just like boot is treated in the like-kind exchange. installment sales. So, the general rule here when we sell an asset is that we recognize gain. It's taxed in the year that it's received. With installment sales, that means that we are going to defer some part of recognizing income or gain. And it occurs whenever more than one payment will happen in more than a year of selling an asset. And this concept applies to things like selling services as well. So when we're talking about a sale, there's three components: interest, return of adjusted basis of property sold, and the gain on sale. In the problems that we're doing here, we basically ignore interest in the book. Now, you can use installment sale method, or you can elect out of using it. Form 6252 is for reporting installment sale income. If you elect out of it, then you just report it on Form 4797, sale of business property, and Schedule D. And depreciation recapture does apply. So if it applies, then you recapture first and you report any additional gain according to installment sale rules. So to go over a calculation, this is how the calculation works. First, you have to calculate the gross profit percentage, which is whatever gross profit is divided by the total income, and that gives you a percentage. So gross profit, if you recall, is income minus immediate expenses related to earning that income, equals a net income type number, gross profit as it's called, which you may recall learning about that on the multi-step income statement in accounting courses. Once you have that number, each payment, you simply times it by that percentage, and that's the amount that is recognized in income. So to give you an example, Zeke's Zipline Adventures sold 6 acres of land used in a business. The sale price was $12,000 and the adjusted basis was $9,000. Zeke will receive a down payment of $4,000 at the time of sale and remaining $8,000 the next year. So how much will be included in income each year? They're asking for the current year. So we take our sale price, $12,000, minus our adjusted basis, gain of $3,000. So now we got to calculate that gross profit percentage. $3,000 divided by $12,000 is 25%. So then we just take year one. We're going to get $4,000 times by the gross profit percentage. So in year one, we would record $1,000 of income. In year two, we times what we're going to get, $8,000 by the gross profit percentage, $2,000, and then you can see over 2 years, we'd recognize $3,000. We got a few other concepts to cover, almost done. Related party losses are disallowed. That's what I was explaining before. And constructive ownership matters here, regardless of what's in paper. So if someone effectively has ownership, but they try to put the name of ownership into someone else, but they have constructive ownership, then that's what applies. And this is to prevent fraud and people just moving assets around to take losses and avoid taxes, offset gains. Now, a wash sale, this is changing topics. This is about stocks, but it's a similar concept because remember, stocks are normally an investment asset. And so if someone buys and sells stocks quickly in order to take a loss, it's going to be disallowed. Now, it's going to be disallowed even if they weren't doing it intentionally to take a loss. But if they meet the wash sale criteria, it's still disallowed. So it applies to stocks or securities, all of them. 30 days before and 30 days after a sale of stock, you have to look and check if similar stock was repurchased or sold before or after the sale, then the loss is disallowed. And the loss is deferred by adding it to the basis of the newly purchased stock. So they don't lose the loss, it's just deferred to when they have activity with the stock beyond wash sale dates. And that is all. We're done. Let me know if you have any questions. I'll see you in the next video.